Hi, this is Joe Elsasser, President and founder of Covisum and also a practicing financial advisor. And welcome to another FinPlan Friday. Today's topic is the Tax Cuts and Jobs Act, or maybe more appropriately, the sunsetting of the Tax Cuts and Jobs Act, which in the absence of congressional action will happen at the end of 2025. Now, what does that mean? What it means is that we will revert to pre-TCJA tax rules. And if you recall, some of the important differences are Tax Cuts and Jobs Act represented a reduction in certain tax brackets. It represented an increase in the standard deduction. It represented a change from 50% deductibility of charitable gifts up to 60% on certain gifts. It also eliminated PEP, the personal exemption phase-out, since there were no longer personal exemptions, and PEAS, the limitation on itemized deductions for some filers. In short, it simplified a lot of aspects of tax planning and created opportunities for techniques to be more effective. Some of those techniques that are more effective right now than they have been in the past, pre-Tax Cuts and Jobs Act, really are Roth Conversions. Identifying situations where clients, once they hit RMD age, will have some of their dollars falling into tax brackets higher than they have to if they just levelized over their lifetime their expected tax bracket. That's one of the big reasons we do Roth conversions. Deciding on harvesting patterns. Which account should I be withdrawing from at which points in my retirement? Sometimes it makes sense to spend money from IRAs early, even if it's going to create a little bit of tax liability, so that it doesn't create a larger tax liability later. Again, back to that idea of levelizing brackets. Another key technique is charitable giving. TCJA increased the amount that you can contribute as a percentage of AGI from 50 to 60%. Now, all of those changes will revert, and though the techniques will still be applicable, they won't be as beneficial as they would be for the next 3 years. Now, we're assuming that Tax Cuts and Jobs Act is going to sunset. In reality, that may or may not happen. There may be some tax legislation that is passed between now and then. But the question that we have to ask is, do we really expect tax rates to go lower? And I don't think there's any reasonable expectation that we'll see lower tax rates than we see today. Instead, whether we revert or whether we see some new tax regime come in, I think right now, for the next 3 years to the end of 2025, we're really looking at a fantastic opportunity to do some great tax planning for clients that will make a big impact over the course of their retirement. Now, tax clarity is a good way for those advisors out there who use tax clarity. There is a checkbox on the input screen that allows you to determine, you can check the box and say, assume Tax Cuts and Jobs Act, or uncheck the box, and we're operating as though the old rules just continued to be indexed. And so it gives you a really unique way of identifying what the difference between a certain technique today or a certain technique if we did not have the Tax Cuts and Jobs Act in place. What is the difference in the impact for a given client? And that's available in Tax Clarity since the passage of the Tax Cuts and Jobs Act. Always been there, but it's going to become more important over the next 3 years as we ponder what will happen going forward. Thanks for joining us today for FinPlan Friday, and we look forward to seeing you on the next one.